British people had been making tools and jewelry with bronze for millennia and also used it as a currency for trade. However, around 800 BCE, a change began to take place. The value of bronze fell, causing social upheaval and an economic crisis similar to what we would call a recession today. Hello and welcome back to the Finance Guardian channel. In this video, we'll explore what causes an economic recession. And as always, hit that subscribe button and the bell beside it. Let's get started. Recession is one of those words no one likes to hear in economics. But apart from the stomach-churning experience of a looming financial crisis, rising unemployment, and much fiscal uncertainty, what exactly is a recession? A recession is characterized by a decline in activity across the economy that lasts longer than a few months and is visible in industrial production, employment, real income, and wholesale retail trade. To be more specific, the definition of a recession can be boiled down to a simple statement that is when the gross domestic product, GDP, declines for 2 consecutive quarters. Julius Schieskin popularized this line of thinking in 1974, but it only captures a small part of a recession's true extent. A recession is declared by the National Bureau of Economic Research. The nonprofit organization tracks changes in business cycles, including recessions. They determine when a recession starts by measuring a variety of indicators such as the decline in real GDP, real income and consumer spending, the rise in unemployment, and the stagnation of industrial production and retail sales. The NBER cannot signal an alarm if just one of these factors fluctuates, which is why Schieskin's two-quarter system isn't the most accurate model. However, these factors are definitely interrelated. If, for instance, more workers find themselves unemployed, consumer spending will surely suffer. Recessions and the business cycle. The relationship between recessions and the business cycles is crucial to understanding the macroeconomic variables that cause recessions. A business cycle tracks the ups and downs natural to all capitalistic economies. Since the cycle tracks the wide range of upward and downward co-movements of economic indicators, it is often a focal point for fiscal and monetary policies aimed at containing the effects of peaks and valleys. As a matter of fact, recessions are considered natural parts of the business cycle. The NBER states that since 1857, there have been 33 recessions in the United States. Business cycles have 4 distinct phases. Phase 1 is expansion, and during this phase, economic growth occurs, which is also known as the normal phase of the business cycle. It is often characterized by an increase in employment and soaring consumer demand, which result in an increase in production and prices. Phase 2 is the peak. This is the highest point in a business cycle when economic output has reached its crest. In this case, there is no other way but down, which sends the economy into contraction. There are various reasons why this can occur. Either investors become too speculative and create an asset bubble, or an industrial production begins to exceed demand. This is usually considered to be the entry point into the contraction phase. Phase 3 is contraction. This is when economic activity declines, often marked by a rise in unemployment and bear markets. On top of that, GDP growth falls below 2%. With a contraction in growth, a recession sets in. Phase 4 is the trough. Business cycles end with a trough, marking the end of the current wave of economic activity and the beginning of the next. This is a turning point followed by a new wave of expansion. It's important to note that business cycles don't follow a predictable interval. Instead, their length is irregular and their severity depends on economic variables at the time. That said, the Congressional Research Service reports that the average post-World War II business cycle lasted 65 months. What causes a recession? Generally speaking, growth and expansion in the economy cannot last forever. A significant drop in economic activity is typically caused by a complex, interconnected combination of factors, including economic shocks. These are unpredictable events like natural disasters or terrorist attacks that disrupt widespread economic activity. A recent example is the brief recession triggered by the COVID-19 outbreak. Loss of consumer confidence. When consumers become worried about the state of the economy, they slow down their spending and try to save as much as they can. Since almost 70% of GDP depends on consumer spending, the entire economy can drastically slow. High interest rates. Consumers find borrowing money to be more expensive due to high interest rates. Thus, they are less inclined to make major purchases like houses or cars. Because of the elevated cost of financing, companies will also reduce their spending and growth plans. Deflation. Deflation is the opposite of inflation. This happens when product and asset prices fall due to a substantial decrease in demand. When demand falls, prices also fall as sellers do their best to appeal to buyers. When consumers see this downward trend, they wait for the prices to fall, further reducing demand. The downward spiral reduces economic activity and increases unemployment, which causes an ongoing downward spiral of slow economic activity and greater unemployment. Asset bubbles. When an asset bubble develops, prices rise quickly, far beyond their fundamentals, like the tech stocks of the dot-com era or the real estate before the Great Recession. Only artificially inflated demand can sustain these high prices, which eventually dissipate and the bubble bursts. This results in people losing money and losing confidence. Companies and consumers cut back on spending and the economy goes into recession. How long do recessions last? It's difficult to estimate the duration of a recession considering the unpredictable nature of business cycles as a whole. But on average, post-World War II recessions lasts 11 months. The NBER follows a retrospective business cycle dating procedure, which means it waits until it has enough data to declare when we have reached the particular phase of the cycle. Instead, what we can do now is draw lessons from past recessions. The Great Recession. The Great Recession occurred from December 2007 to June 2009. It was the worst and deepest economic downturn since the Great Depression. A combination of real estate bubbles and complex investments known as derivatives caused the crisis. Despite lasting 18 months, the recession profoundly affected the decade that followed. American households lost 25% of their aggregate wealth. The retirement savings of many employees with defined contribution retirement plans evaporated. Even if a recession is officially over, that doesn't mean the economy is back to its original shape, and it doesn't mean that the people affected are back to where they used to be. The dot-com recession. A bubble in tech stocks caused the dot-com recession as commercial use of the internet accelerated rapidly from March to November 2001. The Y2K problem, which was a fear that computers and software would break down when two-digit numbers were used to signify years, also led to massive amounts of one-time purchases. The opportunity to own some tech attracted more individuals and institutions, driving up share prices. But as with any bubble, it could not last, especially after 9/11 shook the nation. One of the reasons the length was short, 8 months, was the Bush administration's economic stimulus through tax cuts and Federal Reserve interest rate reductions. The Gulf War recession. Multiple factors contributed to this recession, which also lasted 8 months from July 1990 to March 1991. A spike in oil prices, the move of manufacturing and jobs to Mexico and Canada with the start of NAFTA, 2 years of Fed rate increases, and the end of the Cold War, which caused defense spending to slow down. After the Gulf War, oil prices stabilized, allowing the economy to reach its trough, but the recovery was difficult. The unemployment rate continued to rise, peaking at 8.1% in 1992, a year after the recession officially ended. It wasn't until 1995 that unemployment rates fell below pre-recession levels. How do you fix a recession? The government usually mitigates and reverses downturns by printing more money and lending it at low interest rates. The lower interest rates make it easier for businesses and households to borrow money from banks. Banks can then inject more money into the economy through additional loans, allowing it to recover from the recession. So what makes a recession besides a subjective sense of quote-unquote bad economic cycles, with everything slowing down, people losing wealth, and rising unemployment? The term has taken on a cataclysmic connotation with the pandemic-induced recession and the Great Recession. But here's a short answer. Periods of economic contraction, such as recessions, are a natural part of the business cycle. Although they're inevitable, they're also just temporary. To that end, it's important to recognize the signs and the symptoms of a recession so that you'll be prepared when it does occur. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.